Hi, this is Mani from bsc2nse.com. In this video, I'm going to talk about bond market and stock market and how bond yields will affect the stock market and so on. So both are related to an investor, and let's see how they are related and how they are connected. But before we proceed further, I want to just quickly share about my book, Art of Stock Investing. Now this is available free of cost in PDF format in bsc2nse.com. You can fill out and get a free copy of this book. If you like the book, you can buy the physical copy of this book in Amazon. It's a very small book. You can finish reading it in an hour and you'll find it extremely helpful. So let's get back to this topic here about bond market and stock market here. And any queries you can direct to this mobile number on WhatsApp. So to begin with, we need to understand what a bond market is. So I think I recently made a video about debt mutual fund. You can go through that as well. So a bond market is a place where governments and companies and government entities can issue bonds to raise funds, and in turn they offer the investors an annual interest, which is typically more than what you get in your fixed deposit. So for investors, that is a major plus, that they get a little bit more than what they can make in bank fixed deposit. And for the companies, instead of taking a loan from the bank, they can rather go to the bond market, issue bonds and raise funds. And they may keep floating this again and again after the term is over. So each time they may go to the bond market to keep raising funds again. Now the bond yields typically change based on a few factors like growth, inflation, and RBI's base rate. In case of India, it will be RBI. In case of for the US market, it will be the Fed. And bonds can be bought and sold in secondary market, very similar to how stocks are traded after an IPO is done, where the company raises funds and in turn gives shares. So an investor here, once they buy the bond from the company, they can in turn sell it to another investor in the secondary market. So when they get traded in the secondary market, then the bond yields can change because of the bond value change. So in the long term, what influences bond yields? It will be based on inflation, growth, and RBI base rate. So if inflation keeps on rising, then RBI also will be forced to increase the base rate to contain inflation. So sometimes the bond market may sense, if they sense that the inflation is heading higher, or if they sense that RBI has no more room to cut rates, then the bond yields may begin to increase. So typically when the bond yield is rising, and if the stock market is already at a high, and if the growth is also not so great, then the stock market tends to react in a bearish way, because bond market, very similar to fixed deposit, it is a fixed return instrument. It is very safe as opposed to a stock market, which is relatively risky. So if the markets are already on a high and if the bond yields are rising, then investors may get tempted to shift their equity investments partially into the bond market and wait for a drop if they sense the stock market may drop, or if they're a little disappointed with the growth numbers, and if bond yield is very, very attractive, is on a rising, if bond yields are higher, then they may shift. So let me give you an example. I've just written this out on a A4 sheet and scan this. So let's say the example of I, as an investor, especially if you have huge amounts, let's say at some day, hypothetically speaking, I'm just saying, if I end up with 100 crores, then I'll not want to invest in equity market alone. I will want to invest in fixed deposit instrument and bond market instrument as well. So even today, I will still have some amount of funds invested in gold, some invested in bonds and fixed deposit. So let's say I've invested 60 rupees. This is 12 months back had I started investing. And I've invested 60 rupees at that point in equity and 40 rupees in bonds and fixed deposit or gold. Now gold is not a safe thing. Gold can give negative returns as well, but typically bonds and fixed deposit over a more than 6-month period is supposed to yield a positive return. And while Nifty is growing, Nifty is rising, and I feel very confident about the equity markets, I may pump 20 rupees more into equity market, and because of the 10% rise and the 20 rupees additional influx, this 60 becomes 90, right? And then eventually markets continue to rise, and now we are at 15k, and now the bond yields are getting a little better. Now, because the market has gone up by 50% here, my 90 becomes 135, assuming it also rises 50%. So I'm just taking in exact sync. So now my exposure towards equity is pretty high. So 135 rupees in equity and only 21 rupees in bonds or fixed deposit. This 20 with the interest earned, let's say it rises to 21 or 22. So right now, if you see, I have around 80% in allocation in equity and only hardly less than 20%, 85% to 15% ratio. So I may want to, and if I sense that markets are at a high valuation, I want to do a little bit of profit booking in equity market, then I can take 20 rupees and shift it to bond market. Now, the rising bond yield may tempt me more to do this change here. So this is one of the reasons that I can sense. If you sense any other reason, then you can post it on the comment in the video. So investors will not want to completely exit equity or completely be fully invested into equity at all times. So they'll always want to have some portion in bonds, fixed deposit, and gold as well. So typically when the markets are extremely high and if the bond yields are really good, so that's a zero risk investment. So if the bond yields are really good, then I may be tempted to shift it to bond and fixed deposit. And this may sort of, so that's why markets sort of start falling down if markets are high and the bond yields keep rising. Now, one exception is if growth is extremely good in equity market. If the earnings by the companies are really good, then you may see a case where the bond yields are also rising and the stock market are also eventually rising. So growth is also an aspect here. If growth is really good, then investors may continue to stay invested in equity and they may be less tempted to do this. But if growth is less and bond yields are high, then you may be tempted to shift a little bit from equity and push to the safer investment in bonds and fixed deposit. Now, if I can, you have investing.com here, you can see the 10-year bond yield rate. If you can see the last few months, the bond yield has been on a rising trend, and that's why you could have seen some articles about a lot of investors talking about, rising bond yield, and markets have corrected a little bit. Markets have corrected like 5% to 10% from the top right now, and this sort of matches with the rising bond yield and that being said as a concern. So it could also be a prediction that inflation is set to go higher, and like I said, there are various reasons why bond yield may rise. And this, if it eventually stabilizes and the bond yield sort of cools down, then and the growth matches, growth is really good in the stock market, then stock market can continue to stay up. So there are all sort of possibilities here, but it's always good to understand how the bond market and the stock market is linked. So you can post your comments and questions on this video, and if I missed out any point, you can post it on the video comment as well. Subscribe to our channel, stay in touch. Thank you for watching this video. That's it. Bye-bye.